Hi, my name is Alex Kearney, and today we'll be covering how a health savings account works. This is a re-recording of the webinar that was initially done on June 2nd. Again, my name is Alex Kearney. I'm a development specialist here at Advanta IRA. If you have any questions, feel free to reach out to me directly. I am happy to cover any specific questions you have on HSAs or self-directed HSAs specifically. We'll be happy to get into those for you. So it's important to understand what exactly an HSA is and how it's delineated from the other types of accounts that you can use for healthcare cost reimbursement. The most two common types that people will now see are what are called health reimbursement accounts, or HRAs, or flex spending accounts, FSAs. Now, these are, again, used for the reimbursement of medical expenses, but they are completely different in their structure and utilization than an HSA. So it's important to remember. We'll also go through some of the historical context of this. Now, throughout the presentation, I'll be referring to high deductible healthcare plans, or which are what you need in order to qualify to establish and fund an HSA. In the interest of brevity, I will be referring to them as HDHPs. So anytime I refer to HDHP, it's referring to a high deductible healthcare plan. Now, it's important to understand where we start with regard to the history of health savings accounts. Back in 1984, we had the initial interest from the National Center for Policy Analysis, indicating that the rising cost of healthcare was something that we're going to need to be addressed, and the need for some type of medical IRA that will allow for tax advantage savings for individuals to pay for healthcare expenses. Now, beginning in the early 90s, we have several different bills that are passed through Congress. However, none of them actually stick until the Archer MSA comes about in the legislative session of 1996. Now, these plans allow for contributions, but the early plans were only able to be contributed to by employers, and they were subject to payroll and income taxes, and there was no ability to roll monies from year to year. So let's say you had $1,000 in your Archer MSA in 1 year. You could not then in turn at the end of the year, if you still had, let's say $500, roll that $500 into the next year. It was essentially lost money. Now in 2002, the Treasury Department ruled that we would now be allowed to have HRAs, health reimbursement accounts, also sometimes called flex spending accounts. Now, these contributions can be rolled over year to year, but the employee loses them when they terminate employment with that employer who sponsored the HDHP or any type of healthcare plan that was associated with a flex spending account. Now, this is really unfortunate because if you had worked for someone for quite some time and had considerable amounts of funds built up in one of those plans, you then in turn lost it if you were to terminate employment, or maybe potentially the company was bought out and they no longer offered that plan. Now in 2003, we have HSAs created as we know them. The great thing about HSAs is that they are portable from job to job, and they can also be contributed on behalf by both your employer and the employee. Now, how do they differentiate from other types of medical savings plans? So in essence, the Archer MSA expired in 2005, but if you still have one, you can utilize it, you just can no longer contribute to it. Now, these are limited to self-employed and small businesses, and contributions were made on a percentage of annual deductible. Now, flex spending accounts, or FSAs, cover expenses not paid by insurance, including deductibles, copays, and co-insurance. Under the Affordable Care Act, with these types of plans now, you can only carry over up to $500 per year. So that was a change from previously when they initially came into effect. Now, these are offered by employers alongside traditional healthcare plans. Then the maximum contribution per year in 2020 is $2,750. And remember, these are not portable from job to job, a key distinction between the HSA. Now, what are some of the benefits of an HSA? So the underlying thinking of an HSA is that if individuals are saving their own money, they're going to make more informed decisions about their healthcare, which will in turn help to reduce the amount of superfluous spending on healthcare costs, and again, overall try to reduce the total amount that is spent on healthcare in the United States in general, ultimately lowering the burden on federally subsidized systems like Medicare and Medicaid. Special savings accounts that are set up just for this purpose typically have that effect. Now, keep in mind that these are supplemental to your health insurance coverage. It is not something that stands alone. You do have to have an HDHP in order to qualify for having an HSA. This is not something that you can just start and utilize in lieu of insurance. Now, the nice thing is that even if you have an HSA that is contributed to on behalf of by your employer, even if you terminate employment with that employer, you still get to keep your HSA. Now, the contributions grow tax-free, just like an IRA. Now, your excuse me, the investments grow tax-free, just like in an IRA. The contributions are deductible, just like in a traditional IRA. And when you take distributions for qualifying medical expenses, you do not pay any tax on those distributions, just like a Roth IRA. HSAs can supplement an HDHP and allow for payment of non-covered healthcare expenses with tax-deductible money. So essentially, you get the best of both worlds by being able to deduct the contribution, even if you do not itemize your deduction to the plan, and then also be able to take tax-free distributions of earnings and contributions of those monies in order to pay qualifying healthcare costs. Now, there are two types of HSAs. There's an individual HSA and a family HSA. Now, an individual HSA, as it indicates, is for coverage of a single individual covered by a high deductible healthcare plan. It covers only one person. So even if you do have other family members, if you are the sole individual covered by the HDHP, you are the only one that is allowed to bear the benefits of the tax-free distributions for the reimbursement of healthcare expenses. Now, the self-care coverage deductible must be at least $1,400 for the HDHP, and the self-only out-of-pocket maximum must be at least $6,900, $6,900. Now, keep in mind that these figures, although they are specific, are not necessarily something that I would use as gospel when trying to determine whether or not you qualify for an HSA. There are a lot of small caveats that were brought in by the Affordable Care Act that will preclude even a very high deductible plan that maybe has twice or three times the amount of deductibles and out-of-pocket maximums that you see here on this page, and have some things that would preclude it from having an HSA. So at the end of the day, I would always recommend that you contact your high deductible healthcare plan provider and inquire specifically, just pointedly ask them if it is an HSA qualifying plan. Now, a family HSA can cover all the family members who are covered by that HDHP plan. The family care coverage deductible must be at least $2,800, $2,800, and the family coverage out-of-pocket maximum must be at least $13,800. Now, again, I referenced that you have to have certain requirements in order to have an HSA. Now, this is more to do with the type of healthcare plan that you have or the type of other things that go along with your healthcare coverage. The high deductible healthcare plan cannot have office copay visits for seeing your doctor. Now, other than preventative care, annual physicals, prenatal, well child immunizations, and certain screenings, you have to be paying for the cost of that doctor's visit out of pocket. Or it can also not cover prescription drugs up until you meet your deductible. Now, I was asked a question when I did this live, as if to the effect that if a healthcare plan or a healthcare provider did not charge for the regular visits of someone undergoing, in this case, it was treatment for heart disease, would that preclude it from being an HDHP for the purpose of having an HSA? And in that case, probably not, because if the healthcare provider is not charging for each of those visits individually and only charging for maybe an annual visit at full price, then it wouldn't necessarily come underneath of that umbrella of preclusion. Now, again, keep in mind that you do need to have at least the minimums of the deductibles and the out-of-pocket maximums met in order to have an HSA. But again, the copay aspect can really kind of throw a wrench into systems, because if you go to your doctor's office and they have a copay, so you pay a portion of what that doctor's office visit would charge for just a go in for having the flu or something, then that would preclude that HDHP from qualifying for an HSA coverage. Now, you cannot have other healthcare coverage. Primary healthcare coverage. You can have things like vision, dental, workman's comp, long-term disability insurance. You can have those other types of insurance, and the other non-covered portions of those procedures can be covered by your HSA as well, but you cannot have two primary healthcare covered plans. I was also asked a question whether you could be enrolled in Medicaid. So if you are on government subsidized or fully government provided healthcare, such as Medicare or Medicaid, you cannot be enrolled and you cannot establish an HSA. You have to have strictly a standalone high deductible healthcare plan and cannot be co-insured by another provider or a government provided insurance option. Now, you can also not be listed as someone else's dependent. So this doesn't come into too much of play, except for maybe a younger child that's in their mid-20s, has a high deductible healthcare plan that wants to establish an HSA, but is still listed as a dependent on the parents' tax returns. They cannot establish an HSA. So that's something to keep in mind, although it doesn't come into play nearly as much as the preclusions for Medicare and Medicaid, additional healthcare coverage, and copays. It is something important to keep in mind. Now, when it comes to making contributions to these plans, there's a lot of things to look at. Now, especially with the change of the CARES Act, which bumped up the filing deadline for timely filers, so it moved the timely filing deadline to July 15th, it gives us a little bit of extra flexibility. Because in order to make a previous year health savings account contribution, you typically in other years had to make it by the timely filing deadline, even if you filed an extension. With the CARES Act, the July 15th date is now considered to be a timely filer, and you are able to make a previous year contribution for your HSA, which is a big benefit. Now, how do you determine how much you can contribute to an HSA plan? Well, although we already did go over the amount of although we haven't gone over that, it's important to understand what qualifies you for when you establish the plan, because there is some interesting rules with that. Now, this is called the first day of the last month rule, meaning that so long as you have coverage of the HDHP bound by at least December 1 of the previous year, you can make a full year's contribution into that plan. So you're treated as having been covered by the HDHP for the entirety of the year, even though you only bound coverage by December 1st. Now, you must keep the full year's contribution in the HSA account for a rolling 12 months, and if you do not, you must keep the contribution in, and you must maintain the coverage for a rolling 12 months. Otherwise, you'll be forced to take a pro rata distribution of the contribution that you put in. Now, for example, Ben enrolls in an HDHP plan on 11/30/2020. He can contribute the full $3,500 to his HSA account for 2020, and then take a deduction on his tax return. Now, keep in mind that Ben can do this up until July 15th of this year. If Ben loses the HDHP coverage prior to 11/30/2021, he must take a prorated distribution from the HSA account. This distribution is going to be subject to taxes and a 10% coverage, insufficient coverage distribution penalty, contributing to HSAs. Now, this is very important to understand because there are some rules and some very big portions of misinformation out there regarding what is considered a funding rollover for these accounts. Now, during the presentation, I was asked if you can do certain types of investments, and one individual brought up cryptocurrency. And while that is certainly an available option that you can do within an HSA, it is not something that you can utilize to contribute to an HSA. Any contributions to an HSA account must be made in US dollars. You cannot do it as an in-kind contribution of securities or property. It has to be US dollars that you're contributing. Now, you can do a one-time funding rollover from a traditional or Roth IRA to an HSA, but you cannot utilize a SEP or a simple for that. And keep in mind that the rollover contribution to this HSA is going to be subject to your annual contribution limits. A big thing to remember, though, is that the value proposition for doing this really holds true primarily for the traditional IRA. If you were to do a funding rollover from a Roth IRA to an HSA, you would be putting yourself at a slight handicap, because you are going to be taking money that you had contributed after tax to the Roth, putting it into a pre-tax account that then in turn is going to restrict you on what you can actually take out of that account for tax-free distributions. because at the age of 65, you can treat an HSA as a traditional IRA, but there is no tracking of Roth basis if you were to have utilized a one-time funding rollover from a Roth IRA. So it's important to remember. Now, contributions to an HSA can be made by the employee or the employer on behalf of the employee. Employee contributions are tax deductible, even if you do not itemize your deductions. And employer contributions are not considered a part of the employee's income. So that's a really great aspect of this, is that if your employer decides to contribute on your behalf, you are not having to claim that as additional personal income, thereby not increasing your personal taxable liability. Now, contributions can be made up until the tax filing date, and it's important to remember that with the CARES Act, we have an adjustment of the timely filing deadline in 2020 from April 15th to July 15th. The contribution limits are as follows. For self-only coverage, you can contribute $3,550 per year. For HSA family coverage, you can contribute $7,100 per year. And if you are over the age of 55, you are able to contribute another $1,000 for each, bringing an individual over the age of 55's maximal coverage to $4,550 and $8,100 respectively. During the presentation, I had someone ask me an interesting question. It was framed as if the individual was married and had children, and he was the only individual covered by the HDHP, and the other rest of the family had another healthcare plan, and he contributed to an HSA on a personal fashion, would he be able to use the HSA funds for the reimbursement of expenses that other individuals in the family had? And the answer to that, unfortunately, is no. It is only for the covered individuals of the plan. So for a self-care coverage, that's only for your personal medical expenses, and for a family, anyone that's covered underneath that plan. So it's important to remember is that it must be expenses that occur after the HSA is established, and that you after the HSA is established, and only for the individuals that are covered under that plan as well. Now, I've mentioned several times that there have to be qualifying medical expenses. Now, the IRS was lovely enough to provide us a very comprehensive list in publication 502, publication 502. Now, if you'd like to read that, it is very long and extensive, and we'll answer everything you'd like to in alphabetical order. But some of the most common things that people utilize these for are as follows. You can pay healthcare plan deductibles with your HSA funds. The full cost of doctor's visits, remember, it cannot be the co-insurance, or if there is co-insurance, it is not an HSA qualifying plan. You can pay for dental care, unless it is cosmetic in nature. So office visits, x-rays, cleanings, fillings, braces, those are okay, but cosmetic teeth whitening, things like that, unfortunately not. Vision care, for the purpose of medically required, such as exams, glasses, contacts, and surgery, can be covered. Medication, so your prescription medications, prescribed OTC meds. So if you have a prescription for something like, say, for prescription Advil or heartburn or allergy medication, you can use the HSA for paying for those over-the-counter meds. And also insulin, things like chiropractors, bandages, over-the-counter first aid kits. Disabled dependent care expenses, and this is kind of a really interesting one, capital improvements to a home with the main purpose of medical care. Maybe the individual has become disabled and you need a wheelchair ramp, or you need to lower the countertops to ADA standards, or you need a no-step shower. Things like that, you can utilize HSA funds with zero tax liability for the distribution to pay for. Long-term care, psychiatric and psychological care, and also lodging and trip expenses for medical care. If you have to travel to receive treatment for something, and that can be international travel. I have had clients and individuals that I know have traveled to other countries, South America, India, and other places to get treatment for certain things, have been able to pay for plane tickets, hotels, lodging, transportation, all with HSA funds without having a taxable liability associated to that distribution. Now, because I'm covering qualified medical expenses, that would indicate that there are also non-qualified medical expenses. Now, again, if you do have questions regarding this, please check IRS publication 502, and they will enumerate all of these for you. Now, healthcare plan premiums cannot be paid except for COBRA. So the premiums you have to pay yourself. Now, the COBRA benefits, if you are covered under a plan that is extended by COBRA, then you can pay those. Non-prescription drugs, weight loss program, if it's strictly cosmetic in nature, so things like bariatric surgery for health-related weight loss, those things can be covered. Cosmetic surgery, teeth whitening, nutritional supplements, babysitting, healthcare club dues. A really important one is medical expenses that have already been reimbursed by an FSA or an MSA. So if you have a flex spending account that's associated with your HDHP, and you have utilized that for or paid for something, you can no longer then in turn reimburse yourself additionally from the HSA. Payments for future medical expenses, you already have to have received the treatment in order to pay for the actual service. Now, also, you cannot reimburse yourself for expenses that you have taken an itemized deduction for. So if you are a tax filer that takes advantage of being able to write off medical expenses, you cannot write off those medical expenses in an itemized fashion against your personal tax return and then also take a reimbursement from an HSA. Now, it is your responsibility to keep records of these reimbursements. The IRS puts that burden on you, the taxpayer. The distributions need to be proven that they were used exclusively to reimburse or pay for qualifying medical expenses. So it means you need to keep receipts. The qualified medical expenses had not previously been paid or reimbursed from another source. So keep in mind that if you lose these records, that essentially falls to your responsibility. So securing receipts, most people recommend making copies, have those copies scanned, store them in either some type of filing system in paper, or maybe more securely, store them on a computer or in some type of cloud service. It's very important that you understand that it's your responsibility to make sure that you record keep those expenses correctly. Because if you get audited, then you can have a lot of issues if you cannot prove they were qualifying medical expenses. Now, we've gone through a lot of the restrictions and regulations regarding HSAs. Now, how do you get money out of an HSA? You can take tax-free distributions anytime after the expenses have occurred, and HSA distributions are tax-free regardless of age or how long the plan has been in existence, as long as these requirements are met. Distribution for qualified medical expenses, and the expenses are incurred after the HSA is established. Now, this is very important to remember. Although you can establish an HSA and fund it so long as that you had your coverage bound by the first day of the last month, if you incurred expenses in December, January, February, and March, and you establish your HSA today and make a contribution, you cannot reimburse yourself for those expenses incurred before the HSA was established. So it's important, if you're looking for an HSA qualifying HDHP, that you establish the HSA immediately, because it's not necessarily the funding date, it's the establishment date. So something very important to keep in mind. So let's take a look at a little bit of a case study with regard to how an HSA works. In this example, we're going to be looking at Joe's HSA. In 2017, he opens up an HSA and makes a $3,400 deductible contribution, incurring $1,000 of expenses throughout that year. At the end of the year, he decides to take a $1,000 distribution from the HSA tax-free, which will leave him with $2,400 plus the accrued earnings in that account for future expenses. In 2018, the following year, he makes another $3,400 deductible contribution to the HSA, and he also has surgery this year, incurring $3,000 of out-of-pocket expenses. Again, he takes an immediate distribution to pay those expenses. So at the end of the year, he's left with $2,800 in his HSA, and he incurred a few more expenses, but did not take a distribution for that. In 2019, he has $2,800 in the HSA. So 2 years after the initial establishment, he has $2,800 left, plus some earnings. Now he accumulates another $500 in medical expenses, but this year he decides not to take a reimbursement. Instead, he decides to make a $30,400 deductible contribution to the HSA And even though he accumulates another $1,000 of expenses, he just pays those personally and leaves all of the funds within that HSA to continue to grow tax-free. So now, 3 years later in 2020, Joe has $6,200 plus accumulated earnings in the HSA, and he incurs about $1,500 of expenses. Again, he makes his $3,400 annual contribution, but does not take any distributions for the $1,000 or so of expenses that he has that year for medical expenses. Now, he continues to do this for another 10 years. So in 2030, he's had the account open for 13 years. In the beginning of the year, he has $60,000 in his HSA, which is in the combination of contributions and earnings. In the last 12 years, he has had $20,000 of qualified expenses, but took no distributions. So now he decides that he's had enough time to grow this money. He has a good chunk in there and he wants to take a distribution. So he reimburses himself for the expenses that he has not been already reimbursed for over the past 17 years, or sorry, past 13 years, and takes a $20,000 tax-free distribution from the HSA. Now, in the following year, 2031, he decides he wants to remove some funds from his HSA, but he doesn't have any qualified expenses. So what options does he have? Well, if he's under the age of 65, the distribution would be subject to income tax and a 20% early withdrawal excise tax penalty. However, if Joe is over the age of 65 or has become physically disabled, he gets rid of the 20% penalty, but he just pays regular income tax as if it were a traditional IRA. So the important thing to keep in mind is that with an HSA, you're not locked into only using the funds for qualifying medical expenses, but you do have to wait until you are 65 or older in order to enjoy those benefits. Now, the age for which you can distribute from an IRA is 59 and a half, so you have to wait another 5.5 years in order to use your HSA in a similar fashion. Now, death is an inevitable point in life. Now, what happens to an HSA when the account holder dies? Well, if the spouse's name is the primary beneficiary, they get to treat the HSA as their own and use it for qualified medical expenses. It's fairly straightforward. However, if anyone other than a spouse is named as the beneficiary of the HSA, whatever they are named in the percentage of the HSA, they have to take as a taxable distribution. And if the estate is named as the beneficiary of the HSA, the value of that HSA account will be included in the final income tax return for the decedent. Now, I was asked several questions about what types of things you can invest in with an HSA and how we kind of work in this function. So I'll address one of those questions now. So the difference between Advanta administering an HSA and a larger bank is that although we do not offer debit card access, we offer the ability to invest in a multitude of different types of investments or alternatives, namely things like real estate, notes and mortgages, cryptocurrency, precious metals, private lending, multifamily. And I was also asked what the most common type of investment is. And for HSAs, I would say it's probably lending people money. Notes and mortgages or other types of private loans are probably what the largest percentage of clients with HSAs invest in here. However, we do have clients that have private stock, that have multifamily apartment buildings in them, and also rental property. So there's a very large amount of options there, and you're not just limited to things like stocks and bonds. And another individual had asked if you could buy treasury bills and CDs, and yes, those are also available options to invest in as well. Now, there are some rules about what you cannot buy with an HSA. One, you cannot hold a life insurance contract with an HSA, and you also cannot invest in anything that derives its value from collectability, things like antiques, alcohol, artwork, stamps, rare coins, although you can buy bullion traded coins, things like American gold eagles, silver eagles, things that are sold just for strictly their content value, not a rarity aspect. So a little bit further into this, there are certain people you cannot directly invest with. You cannot buy or sell anything directly to your HSA from yourself or your spouse. You can also not buy or sell anything from an HSA to a lineal descendant or ascendant of the HSA owner, which means also the parents, kids, grandkids, and spouses of those lineal descendants as well. You can also not directly deal or trade with a business entity owned or controlled by a disqualified person or the account holder as well. Now let's take a look at a case study. Now this is going to really show how exactly this works. Now in this case study, it is a little bit more of an uncommon type of investment called an equity participation note. So this means that instead of the person lending the money, in this case the HSA, receiving directly back interest or principal and interest payments on a monthly basis, they would actually be receiving, excuse me, they would actually be receiving a portion of the profits at the sale of the property. So if you want to learn more about that, I have taught webinars on that, or you can give me a call and I'm happy to explain it. But this case study will also do a good job of illustrating that as well. So meet Heather. Heather wants to invest in real estate with others who buy and sell property, and she has about $20,000 in an HSA to invest. It's currently invested in mutual funds. She's not really happy with how it's going. She thinks she'd realize better returns investing in property, but Heather, she really doesn't want to be involved in the day-to-day hassles of owning property and fixing it and everything. So that's why a loan looks a little bit more attractive to her, because it lets her be more hands-off. Now, Steve is looking for an investment partner, and Heather is going to be that partner. He has acquired a property for rehab, and it needs about $20,000 in order to complete the rehab and then to sell. So Heather takes the $20,000 from her HSA and agrees to an equity participation loan with Steve. Now remember that instead of Steve paying her monthly principal and interest payments, he is just going to be giving her a portion of the profits at sale. So this is how the investment looks. The loan term is $20,000. The amount of profits that Heather will receive once the property sells is 25% of the profits. So she'll get her $20,000 back plus 25% of whatever the profits on the property are. And it's going to be secured by a first mortgage on the property. So her HSA will actually have a recorded lien against this property to ensure that Steve pays her back. Now the total profits at sale are $30,000. The tax-free income back to Heather's HSA is $7,500. So at the end of the day, Heather now has $27,500 in her HSA that she can use to pay qualifying medical expenses incurred since she started the HSA. Or she can continue to grow her HSA through additional investments and take tax-free distributions in the future. An important aspect to look at it right here is that there is no taxes being paid on that $7,500 of profit that the HSA made. It's very simple. There's no tax return to file for Heather. It's all being done in her HSA, which is a separate part from her. So it's definitely streamlined some stuff and makes things a little bit easier when doing investments like this. We also had questions about how you actually receive money out of an HSA if you need to be reimbursed for a medical expense here at Advanta. Although we don't offer a debit card access to the account, we can simply just write you a check, and any cash that you hold here is fully FDIC insured, so it's protected by all the typical standards that any bank would provide. We currently administer over $1.3 billion in assets for our clients. We've had over 20 years of industry experience administering health savings accounts, IRAs, 401ks for clients, and every HSA holder here at Advanta has a dedicated account manager, not a team, not a phone bank. You have a singular individual that you can contact and get answers to your questions and help with your account. And if you want to learn more, we hold about bi-weekly events that will help to inform you more on things that are happening. We hold seminars, webinars, networking events. We're actually going to be having a virtual networking event next Friday, so check out our website for that. We have catalogs of all of our webinars on our video library, and we also keep an up-to-date industry news blog for everyone to keep up to date with anything that's happening with regards to changes in tax law, things like the CARES Act and the SECURE Act that will help you stay better informed for your retirement planning purposes. And if you want to get started with an HSA, it takes about 15 minutes start to finish. We help you with everything from getting the paperwork set up. We can even help you if you need to place a call to your healthcare provider to make sure that your health insurance provider to make sure that your coverage qualifies you for this account. We can help you make the contribution. And then from there, it's starting to invest. So I'd say from start to finish, it takes about 15 minutes. And until from the point that a client opens an account till they're ready to invest is about 10 days. It is extremely quick and easy, and we strive to make that as seamless of a process as possible for our clients. Again, if you have any questions, feel free to give me a call directly. My number is 727-754-9954. My name is Alex. Thank you.